Good morning and welcome to Managerial Accounting. As always, we'll start with a look at our calendar so we know what's coming up. Of course, exam 2 was due on Sunday along with the extra credit. So if you have any questions from the exam, I would be happy to go over those with you, but I cannot do those on the recording for, I think, obvious reasons. But please let me know if there are any questions. Review is open on the exam. I would strongly encourage you to go into the exam, see what you missed, and let me know if you have any questions, if there's something that you just can't figure out, or if there's something that you think deserves credit, or you want an explanation for why your answer isn't right, or something like that. I am always happy to entertain those kind of questions, so please feel free to do that. I will be moving those exam grades over into Blackboard, into the gradebook, so you can see an updated grade. I hope to do that this afternoon because I think that's important, because as you know, the gradebook in Cengage doesn't have the proper weights in there, so you can't really see, even though you can see a total grade, it doesn't really reflect what your current grade in the course would be. So I do want you to be in the habit of looking, if you're checking your grade, not that you should be doing that daily or anything, but if you are keeping track of your grade, you're going to want to make sure you're looking at the Blackboard gradebook, not at what Cengage says. All of the individual assignment grades are, of course, correct in Cengage, but it doesn't show the weights that are on our syllabus for each of the categories, exercises, problems, quizzes, and so on. Plus, of course, it doesn't show the project. We finished up chapter 22 on budgeting on Thursday of last week, so the chapter 22 problem should be submitted by the end of the day today for grading. If you have any questions on that, as always, just let me know. That is pretty straightforward. Because we're starting chapter 23 today on standard costing and variance analysis, we will, you should be submitting for grading that chapter 23 pre-quiz by the end of the day as well. So chapter 23 this week. Looking ahead then, I want to talk a bit about the project, because if you look ahead, even on the same page, but into April, on April 5th, so 2 weeks from today, the final draft of your annual report project is due. And I say final draft, for some of you, maybe for most of you, it will be your only draft that you submit. But I want to make sure you're aware of something we talked about at the very beginning of the semester, which is you have the option of submitting a rough draft for that project, and I should put that date in our calendar here. Do that, and there's all day. So you have the option of submitting a draft of the project, and that would need to be submitted 1 week at a minimum, 1 week before the project is due. If you plan to submit a draft, and I try not to use the phrase rough draft because it should be a completed draft. In other words, it should be something that you're saying, I believe this is a completed project, but I just want you to take a look at it for me. And what I do when you submit those is I grade it, I review it as if it is your final submission, and I give the feedback to you on exactly what is missing or what could be improved, and you see your actual grade on that project. The project is out of 80 points, and the project is out of 80 points, and so when you get that feedback from me, it'll say 78 out of 80, here's what's missing, or here's where those 2 extra points could be earned. Then you have an opportunity to resubmit the project with edits, or say, you know what, 78 out of 80 is good enough. I'll take that, and you don't have to resubmit it all. It needs to be in 1 week before so that I have a chance to go through them, and depending on how many people take that option, and what else is going on that week in my work schedule here, I will get that feedback to you as quickly as possible. You always will have sufficient time if you choose to make edits. But the 29th is a drop dead for that optional draft. If you do not submit by the 29th, if you submit by the 30th, let's say, I would try to get to it, but there's no guarantee. And so anything submitted after the 29th may be seen, depending on how many other people submit, may be seen as this is your final submission. So if you choose to take the option of submitting a draft, it needs to be a completed draft, because it is and I don't mean this to sound self-serving, but it's really a lot of extra work and a waste of my time to go through your project and tell you all the things that aren't in there that you know aren't in there because you know it wasn't a completed project. So if you submit and I can see that it's not nearly complete, I'm just going to tell you this is not a draft. This is not a completed draft, and you know what you need to do, go fix it. So generally speaking, the people who submit drafts that week before do pretty well on the project, and probably half of people who do take that option of submitting a draft don't even resubmit because they've done such a good job on the project. So
is there a separate draft or submission spot for the draft?
Good question. So there is not a separate submission part drop box. If you look here in the annual report project area in Blackboard, you're going to submit, and it does explain this right here about the option to submit a draft. You're going to use that same drop box, and that way the grade shows up in the grade book. And if you choose not to resubmit, your grade just stays there. If you resubmit, it's like any other time in Blackboard. If you submit 2 assignments, I would have it set to take the higher of the 2 grades. So if you want to submit a draft, it's going to go in the same step 3 drop box here. And then if you choose to resubmit, you would put your second submission, your updated or revised submission, right in that same drop box. Presumably your grade would then go up, and that grade would just substitute in for the lower draft grade. I guess the other thing I would say is if you submit a draft and then you choose not to make any edits, please don't resubmit the same draft for the final project. It's not necessary. As I just explained, your grade will already be in there, and it just has me regrade your project with absolutely no changes. So it's really a wasted effort. If you don't want to make changes, if you're happy with your grade, you don't need to do anything else. The draft is completely optional. If you choose not to do that, there's no harm. As I said, about half of people who submit a draft will then not make revisions. The other half will choose to make revisions and will improve their grade. Since the project is worth, I think it's a total of 15 points, 15% of your final grade, if I'm remembering correctly. It's about, I think it's, let me just look here. Yeah, so the project is 15% of your final grade. That's actually more than equivalent to an exam. So we have 4 exams worth 50%, so that's 12.5% of your final grade for each of the 4 exams and 15% for the project. The 20 points of the 100 points for the project have already been earned or have already passed, because it was 5 points for having your company approved. That's step 1. And then 15 points for the research. I'm not sure if I've gotten through all of the research, getting the grades in, but that option has passed now to get those points. So, but the 80 points that are left, really, that leaves about equivalent to an exam. And it's completely in your hands how you do on that. So I guess I'm saying this because if you're not happy, if you don't think your exams have been your best work, if they're pulling your grade down, which is probably the case for some people at least, then this project gives you the opportunity to, on your own time, with no time limit hanging over your head as when you're taking the exam, to improve your grade. And if you're really concerned about that, I would, again, strongly recommend that you take this option of doing a draft for your project. Okay, that's enough of me talking about that. Does anyone have any questions about the project itself? Okay. Remember, if you're just really not sure about format, you do have these sample projects in here. You can take a look at those. 2 of them are several years old now. The Pepsi one is a little bit newer than that. That's maybe a year or 2 old at this point. And these are projects that were submitted by students in this class in a prior semester who did what I thought was a really good job on the project, and I asked their permission to share their work in the class to give people an idea. Each one of the projects looks, I think, very different, and yet all of them were probably 80 out of 80 points, or very, very close to 80 points, maybe 79 out of 80. So probably 80 out of 80 for maybe all of them. All right, so if you want to see what a project looks like, if you want to steal their format, you're welcome to do that. There are also in the annual report project area, remember there's a formula sheet here. This is based on chapter 14 in financial accounting. So all of the formulas you need for the project are here. And there's also a link to sample Excel templates if you like. Drew, if you like using Excel for your calculations, you are welcome to use these. Just keep in mind they're sample templates. They may not be a 100% fit for what you need, but they're certainly better than starting from scratch. So feel free to use those. If you do use those templates, you can attach them, save them, and attach them as a second, along with your Word document that is the project itself, and just refer to the calculations in the templates. That's perfectly fine. If you are savvy with Word and you want to import those tables, if you want to put those Excel sheets in Google Sheets and be able to pull the tables in that way, that's a little bit less preferred, because what you submit really needs to be something that's static, not something that you can change after you submit. So I really don't want you linking the tables from Google Sheets that you could then go in and change the tables after you submit. That's true for the project itself as well. There's no reason this would have come up earlier this semester, but it is not acceptable to submit a link to a Google Doc for your project. It has to be a static document that can't be changed after you submit it, because otherwise, I think you all get this, there's nothing to prevent you from submitting a link and then going in and working on the project over the next few days or however long until I review it. So it needs to be a static, unchangeable document that is submitted, not a link to a document that you control. Make sense? Any questions before we turn to our new material? Okay. So just because we've had a couple people join us, let me just go back to the calendar for a moment and just say one more time, if you want to submit a draft for the project itself is due on April 5th, and there's no obligation to submit anything for the project before April 5th if you choose not to do that. However, if you want me to grade what you think is a final version of the project, if you submit it by March 29th, so that's 1 week from today, I will grade it as if it's your final project and let you know exactly what your grade would be and exactly what you would need to do to improve that grade. And then you'll have an opportunity, after I review it, you'll have at least a few days to resubmit an edited or revised version as your final project by the 5th. All right. Okay. Nobody said anything so far in class today before, so I can't say, are there any more questions, but are there any questions, anything you want to say before we turn to our new chapter for today, which is chapter 23? I was pointing out before class, just as we go to that, I was pointing out before class, it seems to me that people are ready for a break in the semester. And unfortunately, the timing of our spring break this year is not ideal. In my mind, we do this mainly so that it lines up with spring recess for the public schools, so that, you know, many of our students have children in the public schools. And so I think that's why. I know when I came to work here 17 years ago, that was one of my things that made me happy, because I had children in the schools, and I liked the fact that JCC's break lined up with their break. Prior to that, I had been at Bonaventure, and their break did not line up with my kids, and so I never had the same time off as they did. So for that reason, I think the timing of the break is good, but from an academic standpoint, it's not so good. I think to me, it shows because, you know, at 5 minutes of 9 today, the first student got here for class, and that is not what has happened earlier in the semester. So I think that speaks volumes that we're ready for a break. Unfortunately, the break is not until the week leading up to Easter. So you can see on our calendar here, we have nothing due over that break, but we just have to make it to that point. And then once we come back, it's just the last couple chapters to cover. So keep going, hang on. We've got just, we're just going to keep plugging away, and hopefully that break will give you just enough steam to finish up the semester strong. Okay. And if there aren't any comments, questions, anything, we're going to go to our new chapter for today, for this week, I should say. We'll be covering a chapter a week, as we have been for the remainder of the semester. And our chapter that we're starting today is related to standard costs. We'll start out with a discussion of what standard costs are, and then we'll be looking at how do we analyze differences between our actual costs and those standard costs, and what do we do with that information. So you can see we have, and there are some more learning objectives on the next slide as well. You can see that we are going to start out talking about what standards are, how do we use them, how do we calculate them. Our first exercise will be, where do these standards come from? How do we put them together? We will then look at how we use that information to evaluate performance of our management, of our operations. We will be looking at how do we calculate variances in the 3 product component costs: direct materials, direct labor, and overhead. And then at the end of the chapter, we'll be looking at how can we use this for a service organization. We do that in many of our chapters. So how does what we're learning here relating to manufacturing, how can we then use that for a non-manufacturing entity as well? You can see that there is an appendix for this chapter, and as always, we won't be covering that appendix. You're not responsible for it. You don't have to read it. We won't have any exercises. It won't be on your exam or on the problem. It may appear in the pre-quiz, and I can't control that. I don't control what's on the pre-quiz. So it may be in the pre-quiz, and the only thing I can tell you is just do your best on that question and know that if one comes up, and know that you only need to get a 60% on that pre-quiz to get full credit. So I said we would start with what standards are. So standards are the goals. These are what we want to have happen or what we expect to happen based on information that we can gather. And just like we talked about in the budgeting chapter, chapter 22, the standards are based on information, feedback, information from a variety of different sources within our organization. These really do line up with the budgeting process. Most manufacturing companies of any size are going to use a standard cost system, which means that they report their costs as what they should have been paying or should have been incurring for cost based on those standards. And then at the end of the period, they do an exception report. So they say, here's what the standard said, here's what actually happened. We're going to make an entry for that difference, that variance. That allows us to be more efficient with our accounting time and the entries that we make. It allows us to focus on not the full cost, but how far was that actual cost from what we expected or thought we would pay based on the standards. So it does help us with that concept of managing by exception, that we are looking at the differences from what we intended or expected. So where do the standards come from? And how often do we adjust our standards? My suggestion is we need to keep an eye on those standards. In just a moment, we'll get to what are some of the criticisms of using standard costs. But it is important for us to keep an eye on those standards and see, make sure that they're kept up to date. Where do we get that information? Just like we discussed in the budgeting chapter, it's going to come from the people who should know, the people inside our organization who are responsible for determining, for example, what materials and how much materials go into the product that we're making. We're going to be talking with human resources about how much we're paying for direct labor. Exactly the same conversation that we had in chapter 22 in budgeting. The standards really are a part of that budgeting process. But what we are discussing here is the standards for the product, direct materials, direct labor, and overhead. Remember we talked about a couple chapters ago in the CVP analysis chapter, we talked about 3 different versions of the term capacity. And I told you at the time that when we talk about capacity, there's theoretical capacity, which is the perfect world where nothing ever goes wrong and we work 24/7, 365, and there are no slowdowns, no stoppages, no shift changes, no vacations, no maintenance on machines, no breakdowns. Well, we talk about the same thing as it relates to standards. We can put together that ideal standard, which conceptually matches up with that theoretical capacity, but that's not helpful at all. It's nice to talk about it maybe in closed doors. In a perfect world, we could do this. But if we hold that out as the standard that we expect our workforce to meet, it's actually going to be have a, the word I'm looking for. It's probably going to have the opposite impact of what we intend, because it's so impossible that it's going to be deflating. It's going to be demotivating. If we set a standard that is attainable, and we've talked about that concept of a SMART goal, that's really what the standard should be, is something that's realistic, it's attainable, that is something to strive for and is within reach, although it might be a long reach. We want to use that as a motivating tool, not as a, we're never going to get there, so why should we even try? What we are going to be using is normal standards. And this lines up with what we, in the concept of capacity, refer to as practical capacity. This is something we can do it should be, most of the time, it might be something that we're not currently achieving, but it's something to strive for. Does that make sense? So we want it to be realistic, something that's attainable, but maybe above, maybe better than what we have right now. I shouldn't say above when I'm talking about cost, because that makes it sound like the cost would be higher than what we're paying right now. That's not what I mean. Something to strive for. How often are we going to review these? Well, at least on an annual basis, as part of the budgeting process, we should be taking a look at our standards to see, do these still make sense? It may be that we have to review those even more often, although when we talked about the concept of a static budget and a flexible budget, if we change our costs mid-year, we have to recognize the impact that that might also have on our budgeting process. And if we are an organization that has a static budget and that budget has already been approved by maybe our board or administration, the officers of the company, or however our budget process works, we need to be very careful about changing our expectations without getting buy-in from all of those entities, including whoever may have already approved that budget for us. But right now, as you can imagine, with prices increasing, and we've talked about this over the last couple of weeks, as we see prices increasing for lots of commodities, including steel and diesel and gasoline and other materials that might become part of the project or be necessary for our manufacturing process, companies absolutely need to be looking at not necessarily changing their standards, but recognizing the impact that those economic conditions might have on their results. So they need to be taking that into account, figuring out, what impact is this going to have on our bottom line. As I said, we're going to look at the some criticisms of using standard costs. So if we set a goal, and that goal is not a stretch goal, if it's not something that's encouraging us to do better, it may actually be limiting our ability to improve, because people look at that goal and say, got it, we're good, we don't have to do anything else. So it might discourage the identification of some efficiencies. One way around that, of course, is to incentivize or motivate people to achieve better than the standard. So it's not uncommon in a manufacturing environment to have, say, a bonus structure or an incentive plan that rewards exceeding the standards, rewards finding cost savings that go beyond what the standards would indicate. So that's one way we can get around that. I already mentioned that we need to be careful that our standards are kept up to date. So as conditions change, we need to make sure that we are taking that into account, at least on an annual basis as part of the budgeting process, but maybe more frequently if we are, as it points out here, in a dynamic, changing working environment. We need to make sure we're keeping that in mind. We want to make sure that we are keeping the big picture in mind for the company, not focusing just on improving efficiency, but actually improving the entire performance of the company. And keep in mind, I think I've used this expression before in class, that we're all on the same team. So we're all working for one goal, which is the overall company, not just our department. And so maybe purchasing or supply chain is rewarded for buying a less expensive material, but it turns out on the manufacturing side, that less expensive material is also of poorer quality. And so guess what happens? They have more scrap, more non-conforming material. And so yes, it saved money on the front end because our purchase price was lower than the standard. However, it may increase the total cost of producing that because it takes rework and we're scrapping material, and so we need to keep the big picture in mind. what's the impact of what we are doing on the operation as a whole, which, you know, for many manufacturing companies is going to mean delivering quality product on time. And if we're scrapping product, it's not a quality product. If we are having to rework product because we bought a faulty or a substandard material, it could be that that rework process means that we're not delivering on time. So these are some of the typical criticisms of using standard costs. I don't think any of them is insurmountable. In my view, it is still better to have something as an expectation rather than, you know, what's the alternative? If we don't use standard costs, we don't have a performance benchmark. How do we know how we're doing if we don't have something to compare it to? Most of you have heard me saying that all through financial accounting. When we say, you know, we're looking at a financial ratio, for example, you're going to be doing that in your project here very soon if you're not already. And we're always going to be doing a compared to what? How is that good? I don't know. Compared to what? Is it good compared to last year? Is it good compared to other companies? As you're looking at your project, 30 of the 80 points is for the financial analysis piece of the project, and that's where those Excel templates that I just showed you where they were in Blackboard is going to come in. I want to just take this opportunity to point out, because this is something that people, more often than not, if people are missing points in the financial analysis section, it's for one of two reasons. The instructions for the project, I just want to go to those for a moment, and I apologize for jumping around, but it's relevant to what we're talking about here. If we go to the instructions for the project and we go down to the financial analysis portion. So this portion of the project is worth a total of 30 of the 80 points, almost 40% of the total value. So I want you to notice this says for the past 2 years. So you're going to be calculating each one of these ratios or calculations for 2 consecutive years. That may mean you need to go to the company's annual report from the previous year in order to get the beginning balances, for example, to find the average receivables or the average inventory for the first year of your data. If your company has 3 years worth of data on your report, you're good. But if there are only 2 years on there, which is the minimum that's required under GAAP for comparative financial statements, if you only have 2 years worth of data on your balance sheet, maybe on your income, on the balance sheet is where it's really going to affect you. You will need to go to either a website like Yahoo Finance, where they always show like 5 years worth of data, regardless of what's in their annual report, or access the company's annual report from the previous year, and you'll find those beginning balances. So you're going to be calculating each one of those ratios for 2 years. And that's something that people sometimes only calculate 1 year. And the other thing that needs to happen is this: discuss the significance of. So what I'm looking for there is that for each of these 5 areas, liquidity, profitability, long-term solvency, cash flow adequacy, and market strength, those are the 5 areas that you're going to be analyzing. You do not, please do not tell me, for example, working capital increased from 2019 to 2020 or 2020 to 2021 or whatever your last 2 years are. Current ratio increased. I can see that. You're giving me the numbers. I really don't need you to tell me it increased or it decreased. I can see that. This discuss the significance of means you tell me, not line by line for each ratio, it changed and here's how much. But in each of these 5 areas, what happened to liquidity overall? Did liquidity improve during the during the 2 years from last year to the most recent year? And how do you know that? Is it because working capital and receivables turnover went up and three of the other things went down? That's the kind of significance I'm talking about. What does this mean for your company? Based on what you're seeing, the change just from one year to the next. So 5 areas, you should have a few sentences, a short paragraph is sufficient. You do not need to address individually each one of the items, but as a whole, what happened to their liquidity? Is that a good thing or a bad thing? And how do you know? What evidence do you have based on these calculations that you did? Does everyone see that? So those are the 2 items that people are most likely to leave off their report, and it does, of course, have a significant impact on your grade, because this section is a big chunk of the overall grade for the project. So make sure you're doing both of those. So how is that related to what I was just talking about here? We need to have something to use as a comparison. And in the project, you're comparing last year to this year. As we're discussing in this chapter, we're comparing this year's results to some standard that we have set so that we can say, how are we doing? Are we doing better or worse? We need to have something as a comparison. And so people who are suggesting that we shouldn't use standard costs, or that there are problems with standard costs, I don't know that they're proposing something that would be a better situation. Maybe the criticisms are just meant for us to keep track of, okay, we know that one problem is you hit the standard, you rest on your laurels and say, that's good enough. Maybe that criticism is just to make us keep in mind, we need to do something to make sure that people are always striving for improvement, even if the standards are easily attained. Let's go to our first exercise for the day, and that is here. I'll give you just a moment in case you do not have your exercises open. This is the first exercise in the chapter 23 exercises, setting a standard product cost. Atlas Furniture Company manufactures designer home furniture. Atlas uses a standard cost system, and we've just described what that would be. They set the standards up front. You can see the standards that they have established right here. They set those standards, and then in their accounting records, as they're making the product, the standard costs are what they're moving through the inventory account. So starting back in chapter 15, we looked at in chapter 16 in the reference materials. Remember, you've got that flow chart if you want to review what that looks like. But we have the 3 inventory accounts: materials, work in process, finished goods. We're moving our costs through those inventory accounts. Give me 1 second. So as excuse me, the little break there. As we look at these standards, it's these standards that are going to be moving through the records in the accounting process. And then once the product is finished, we compare our standard costs to the actual costs, and we have adjustments, or we make an entry to recognize those variances. Direct labor, direct materials, and factory overhead standards for an unfinished dining room table are as follows. So it's important for us to know that for direct labor, there are 2 different standards. And as we get into, in a couple exercises from now, as we get into finding the variances from these standards, we're going to be looking at direct labor as a whole, but also what makes up that direct labor. So when we look at direct labor as our first example, we have a standard for how much we're going to pay our direct labor per hour and how much time it's going to take. So different companies, different textbooks use a little bit different language as we talk about this, but really what it comes down to for each one of these, for direct labor and direct materials, is how much did we use So that's a quantity standard. And how much did it cost us per unit of use? And so when we're talking about direct labor, the units are number of hours. And when we're talking about direct materials, the units are going to be something else other than hours. So here we're talking about the direct material being oak, the wood that we're using, and the unit is board foot. So as we talk about how much we use, we're measuring it in board feet. And then how much did it cost us is going to be based on that unit of board feet. We have to have those two separate standards. And when we do our analysis, we may start at the macro level and say, okay, direct labor, what was our total variance from what we should have paid? But then we need to tease it apart to say, yeah, but why did we have that variance? Did we use too much direct labor, or did it cost us too much per unit, per hour? Same thing with our direct materials. We might look at the total variance for direct materials, but then we have to tease it apart. Did we use too much of the wood, or did we pay too much for the wood we used? So we're going to have those two different sources of variance within each category. Then, as we've been doing since the CVP analysis chapter, we will need to have a separate standard for our variable and our fixed overhead, and we're going to talk about those separately. The variable overhead will look similar to what we did with direct labor and direct materials. Because the assumption is if it's variable, when we produce more, we should be using more of them, incurring more of those costs. And so the variable overhead will include that same quantity. How much did we use and how much did we pay per unit of use? But the fixed factory overhead is going to be different. This is the only fixed cost we're talking about here. When we have this standard rate of $3.80 per hour, that's going to be based on our expected capacity. And so if we produce more or less, we'll have a volume variance, and we'll also have a spending variance that our total factory overhead may be different than what we had expected or budgeted. So again, 4 different costs: direct labor, direct materials, variable, and fixed overhead. Each one of them will have 2 different variances associated with it. Our job for this exercise, though, is just to figure out, to make one table, how much should it cost us? And so I'm going to get my annotate up here, and we'll do these calculations. So we'll start with direct labor. That's where I can see. We'll start with direct labor, where we expect to use 5 hours of direct labor, and we expect to pay $28 per hour for that direct labor. So the standard cost per table for direct labor is $140. Well, it might be that we pay exactly $28 an hour, but it takes us 4.5 or 6.5 hours. And then we would have that quantity variance. It might be that it takes us exactly 5 hours, but our average cost is $29 an hour. It might be that it takes us more or less time and that the hourly rate is different. And so we'll see that as we go through some of our exercises before the end of class today. Then we have our direct materials. And as is frequently the case, we have a very simplified product here that we have just one direct material. That's not going to be a very common occurrence, but for this exercise, it makes it easier for us to do the calculations. And as I've said many times before, if you can do it with 1, you can do it with 10. So we don't normally need to go through 10 of these. So we have 18 board feet of lumber we expect to use to make one table. And we expect to pay $12 per board foot. Again, once we start making the product and comparing what we have to what we actually use to what the standards say, we may find out we used more or less of the material and that we paid more or less than the standard for it. As we get to calculating variances in just a few minutes here, we will see that the variances, each one of our variances, we need to recognize and label it as being either a good thing or a bad thing, favorable or unfavorable. It's important that we recognize that difference, that there are also favorable variances. And we might want to focus not just on the unfavorable ones, but on the favorable ones as well, as we're looking at how do we use this information to manage our company better. We want to look at those favorable variances to see, is this something that's going to keep happening? How do we get this to keep happening? Because saving money is a good thing, mostly. Moving on then to our variable factory overhead, you can see that our rate standard that we set is $2 per direct labor hour. And we expect 5 direct labor hours. So we're going to assign $10 in variable factory overhead to this table. 5 direct labor hours at $2 per hour. And then the last piece is the fixed factory overhead. And again, that's the one that does not follow the flexible budget concept, where we really just want to be looking at how much did we actually use. So now to find the standard cost per table, this is just the product cost. Remember, that's all we're focusing on in this chapter is the product cost, direct materials, direct labor, and overhead. So if we combine those 4 pieces, I got $385 per table. And so as we're making each table, we're going to assign it as it moves through our accounting records. It's going to be assigned $385 for the table. And once we finish the table, we're going to compare that standard $385 to, okay, what did it actually cost us? And we're going to tease out these variances, 6 sources. Let's answer our questions here. A standard cost system provides Atlas Furniture Company's management a cost control tool using the principle of management by exception. I used that term as we were doing the introduction. Using this principle, major cost deviations from standards can be investigated and corrected. And so the company may we have the standard of $385 per table. Maybe if the overall cost comes in at $386, they say, you know what, that's close enough. The company is going to decide what is a large enough deviation or variance from those standards that it needs to be investigated. They may start with the total cost and say, yeah, that's close enough. They may have a policy that 1% cost overrun or 1% cost difference is close enough. It might be 5. If it's within 5%, we're good. They may have a policy that they always look at the various components, direct labor, direct materials, fixed and variable overhead, to investigate differences in each one of those categories. As I already mentioned, we're going to be looking at we're going to be calculating favorable and unfavorable variances. And so if you think about it, if we have favorable variances in one area, unfavorable variances in another area, they're going to, at least to some extent, cancel each other out. And so let's say our cost for the table came in at $386. It might be that our direct labor went over by $20, but our direct materials was under by $19, or however that would work out. The other way around. That'd be, oh yeah, that was it. Over by 20 and under by 19. And so that cancels it out to give us that only $1 net variance, but we might be missing something. Why did the direct labor, which should have been only $140 in our standard, why did it come in at $160? If our policy is we only look at the big picture and then only investigate major differences from that big picture, it may be masking something that is a problem for us. And so in my example, I said then the direct materials comes in under budget. Well, what if next month or next week or whatever, what if our direct materials comes back into line with the standard, but our direct labor is still high? We've missed an opportunity the previous month to find out what's going on there because we didn't recognize that difference in the direct labor because it was partly masked by the favorable variance in our direct materials. So I'm not suggesting that every variance, no matter how big or small, no matter how small, needs to be investigated. All I'm trying to suggest is that it's up to the company to decide at what level do they look at this variance and what level is considered major. Is it 1%, 2%, 5%, 0.5%? It's up to the company to make that decision. There's no right answer.
Would it kind of also be based on the volume of output too? I mean,
Could be.
$1 per table if you're producing 100 tables a month is a huge difference than $1 per table if you're producing 10,000 tables a month.
Mm-hmm. Yeah, dollar-wise it would be different, but the percentage difference would still be the same. So yeah,
Well, that's why I'm asking. That would be
Yeah.
volume output. If you're putting out more, it matters more, even though the percentages are still pretty much the same.
Yeah, it's, I don't know if you can hear the question in the classroom, but the question was, would volume come into play here? And there's really, again, no wrong answer. It's up to the company to decide. If you're a small company, yes, $1 a table in total is fewer dollars than if you're producing, if you're producing 100 rather than 10,000 tables, but it's also a bigger significance to your bottom line because you're a smaller company. So the interplay here, the balancing act is that same cost benefit analysis, that it's going to take more time and effort to investigate what might be minor differences from our standards with our actual costs. We have to pay someone to do that. We're taking time of their workday investigating something that may turn out to not be significant. And so we have to decide at what level is it worth it. And there's no right or wrong answer to that. It's up to the company to make that decision. So I can't tell you what the answer is. I can't even tell you if this was my company, what I would say, because it really depends on the situation. So we already talked about setting cost standards. We just saw in that previous exercise, we saw that the standards had already been set and then we calculated the standard for the product. We talked about at the beginning of class where those standards come from, who provides that information. Human resources, the supply chain staff, the engineering or design staff are going to decide how much and what materials we're going to use. So we're going to be soliciting that information just like we did in the budgeting chapter. We're going to be soliciting the information for the standard costs from the people inside our company who should know. What we're going to be doing in this next exercise, as I said when we were looking at the learning objectives for this chapter, is so what do we do with this? We have these standard costs. We know we're going to be moving those standard costs through our accounting records, and then at the end of the process doing a comparison between what we expected to pay, what we actually paid, identifying those variances, entering adjustments as needed to correct these standards to our actual costs for our financial statements. Of course, it's not okay on our income statement, for example, to report just the standard costs. It needs to be our actual costs. So we need to be doing that adjusting process at the end. But what do we do with this internally? And in this exercise, we're going to be doing a comparison, a budget comparison of here's what we thought we were going to spend, here's what we actually spent, Are these costs favorable or unfavorable? What's our total difference? And then decide, now what do we do with that? That last question, okay, now what do we do with this, is going to be the hardest question for us to answer, but it really is the most important question for the company to answer. It makes absolutely no sense, other than correcting our financial accounting statements, reports. It makes absolutely no sense for us to identify all of these variances and then do nothing with that information. As we said in Chapter 1, the whole point of accounting is to help decision makers make decisions about our company. In Chapter 15, back in January, when we talked again about the differences between financial and managerial accounting, we said that managerial accounting is different from financial accounting because those decision makers are inside our own company. And so as we look at these performance reports here, it's not enough to identify the variances. The next step is, okay, now what do we do? Knowing that the variances exist does not automatically lead to improvements or fixing any of the problems. We need to identify the problems through this variance calculation and then do something about it. And that's the part, as I said, that is difficult for us to do in the classroom, but is really the most important point in the actual work setting. Now, what do we do about it? How do we fix this for going forward? And the answer could be, you know, our standards really are not realistic anymore because costs have gone up. At the same time, the answer might be that we need to change something in our process, that we might not be meeting those standards because of some inefficiency within our system, within our manufacturing process that can be improved. Either way, if we have a major variance, we need to do something about it. So let's look at our next exercise here. Any questions before we start with this? Salisbury Bottle Company manufactures plastic 2-liter bottles for the beverage industry. The cost standards per 100 2-liter bottles are as follows. Direct labor, $1.20 per 100 bottles. Direct materials, $6.50. Overhead, $1.80 for a total cost of $9.50 per 100 bottles. At the beginning of March, Salisbury's management planned to produce 500,000 bottles. That's their normal capacity. It's what they expect to produce. The actual number of bottles produced for March was 525,000 bottles. The actual costs for March of the current year were as follows, and we're asked to prepare the March manufacturing standard cost budget, excuse me, assuming their planned production. So as I already pointed out, the direct labor and direct materials and the variable factory overhead piece should flex with our changing production amounts. The fixed factory overhead, though, if we're correct that it's truly fixed, should remain the same whether we produce 500 or 525,000 bottles. And as we move through our next exercises, actually into Thursday, when we get to the variable and fixed overhead calculations, at that point, you will see the impact of why it looks different, how we analyze the variances for the fixed factory overhead than for how we do the other three, which are variable. So we expected to produce 500,000 bottles. Oops. 500,000 bottles. Now remember, these costs are per 100 bottles. So if you want to think of it as batches of bottles, batches of 100, 500,000 bottles would be 5,000 batches of 100 bottles. And that will allow us to take just the 5,000 batches to multiply by these unit costs, the standard unit costs. So 5,000 units at $1.20 each for direct labor. $5,000 batches each for direct materials at $6.50 per batch. And then finally, 5,000 batches of 100 bottles at $1.80 each. And not taking into account our actual production, our planned production was 500,000 bottles. Whoops. I am hopeful by the end of this semester, I will be a little bit more competent with my calculator. It's really kind of silly. Okay, so when we looked at our standard cost based on our expected level of production, we have a budget of $47,500. That's how much we expected to spend on bottle production for the month of March. Again, this is the static budget based on our expected level of production. As we come down to our,
Cindy,
yes,
sorry, really quickly, I have a question. So you did the 500,000. What did you do? I'm sorry.
it's okay.
To get the 6,000 and 32,500.
So whoops, get back up here. So these standard costs were for 100 bottles.
Mhm.
So if we produce 500,000 bottles, and there are 100 bottles in a batch, that's 5,000 batches, right? And so I took the 5,000 batches that we expected to produce and multiplied by each one of these standards. So 5,000 times $1.20 is the $6,000 here. 5,000 batches at $6.50 each would be the $32,500. And then finally, 5,000 batches at $1.80 each would be this $9,000. Oops.
Thank you.
So that's what we thought was going to happen for the month of March. Turns out we actually produced more than that. So over the last few chapters, we keep seeming to encounter this concept of pull-through production. And as we talked about absorption versus variable costing, I hope it was clear that the one concern of absorption costing is it incentivizes producing for inventory because it allows us to shift some of those fixed costs onto the balance sheet as an asset rather than expensing them in the month they're incurred. The reason I'm bringing that up now, other than to help you see the connections between what we're doing in each chapter, is it tells us in this exercise that they expected to produce 500,000 bottles, but they actually produced 525,000 bottles. And I'm just going to suggest that I hope from a management standpoint, the reason we produced more bottles is because we had demand for more bottles, because we knew we could sell them. Otherwise, producing just because we can, because we have the capacity to do that, actually encourages inefficiency. And that's certainly not going for that. So this budget in part A is for what we expected to happen, assuming we made 500,000 bottles, 5,000 batches. But what we're going to be doing here in part B is, yeah, but what if we actually produced 525,000 bottles? And I just, let's pull our actual cost in first. I'll save my comment for a minute later. So our actual costs are given to us right here. So the actual cost column on the budget performance report is simply going to pull those numbers that were given to us as the actual costs. So go ahead and pull those in. Now I'm going to put something in this next column. These are not the correct numbers. I just want to show you something. Just want to show you something. We talked about in the last chapter the concept of a flexible budget compared to a static budget. And we said that using a static budget can lead us to a conclusion which is really not correct. And I want to show you what that would look like here. If this company did not use a flexible budget, if they did not recognize, oh, our production was actually more than we had planned, and they simply pull in those static budget numbers, this is what it would look like. You'll notice the heading on this last column says cost variance, and it shows favorable in parentheses. We've probably mentioned this, you've probably seen it in an earlier chapter, but just a reminder, if a number's in if a number's in parentheses like that, what it means is it's a negative number. In accounting terms, parentheses around a number, and or if the number's in red, that indicates that it's a negative number. Because of the way the software works, we're simply going to use the minus sign, and it tells us that right here. Enter a favorable variance as a minus sign. But if we were not using this software, if we were just producing a report, rather than using the minus, in accounting terms, we normally would put a negative number. Rather than using a minus sign, we would just put parentheses around it. That tells us that the number is negative. An unfavorable variance then is going to be a positive number. So an unfavorable variance would occur when the actual costs exceed the standard. When I use the static budget here, the actual costs exceed the budget for direct labor by $550. The actual costs exceed the budget, the static budget for direct materials by $1,300. And for factory overhead, it exceeded it by $100. And so, again, these are not the correct numbers for this exercise. I just want to make a point here. For this company, if they did not use the flexible budget numbers, if they only compared their actual costs to their standard costs at their expected level of production, what do we see here? We see an unfavorable variance, a cost overrun in each one of those three categories. Well, wouldn't we expect that when we produce more than we had planned? We would expect to spend more money, in particular on the variable costs. All of them should be higher. And so using the static budget that we just put together in Part A is not very helpful at identifying cost overruns. And so as I said, those are not the correct numbers for this exercise. I'm going to take those out, but I just wanted you to see what that would look like. And what we need to do now is recalculate a flexible budget based on these unit costs that we had here, but the actual number of batches that we produced. And so rather than producing the 5,000 batches of 100 bottles that we expected to produce, we actually produced 525,000 or 5,250 batches. And so I want you to take just a moment and redo the budget based on our actual level of production. Now, the one thing we cannot do is, and we know we should be doing, is the factory overhead includes both fixed and variable overhead. And the fixed part should not go up just because our level of production increased. Based on the information given here, we are unable to separate that. It does not tell us how much of that $1.80 for factory overhead is fixed and variable. So we have to do the best we can with the information we have. And we're simply going to, for each one of these categories, components of the product cost, we're going to take the 5,250 batches we actually produced and multiply by the standard cost per unit. So go ahead and do that. Everyone okay with what you're doing? 5,250 batches at each one of those component costs, standard costs for the batch. Whoops. And then total those. Now we can do our variances based on those flexible budget quantities. Again, you're subtracting actual minus standard cost. As long as you do it in that order, if the actual cost is higher than the standard cost, you're going to end up with a positive number. And we are told here that that is an unfavorable variance. If we end up with a negative number when we subtract actual minus standard, if we end up with a negative number, that tells us it is a favorable variance, that our actual cost was lower than expected, as we see here with the direct materials. And so what do we see? We have a cost overrun in direct labor when we produced more, even using the flexible budget. We saw a larger impact when we didn't take into account the additional production. When we compared it just to the $6,000 here, we saw a larger unfavorable variance, but it is still slightly unfavorable. I don't know what percentage that is. It's about close to a 4% variance. Again, the company is going to decide, is 4% something they can live with? Are they concerned about that? How much investigating, how much time do they want to devote to finding out why that's different? But for each of the other two categories, direct materials and factory overhead, we now have a favorable variance. Our costs actually came in below what we would have expected based on the actual quantity of the flexible budget. So, excuse me. So our total variance compared to budget is less than 1% of the total. Actually, it's only about 0.9% of the total. And so, as I suggested, the company might, it's up to the company. Remember, this is all internal decision-making. This has nothing to do with our external reporting. The external reporting is always going to be at our actual costs. It has to be. We don't get to put on our financial statements how much we wanted to pay for a product. We have to put on there how much it actually cost. So all of this that we're doing now is internal decision-making. And it could be that the company looks just at this line and says, we were within $425. It's less than 1%. We're good. No need to do any more analysis. No need to tease apart the direct labor into its price and quantity, the direct materials into its price and quantity, the factory overhead into its fixed and variable. Each one of those has two components. We don't need to do that because we're less than 1% away from where we expected to be, and that's good enough. It may be, though, that the company looks at the detail of each one of the 3 areas and says, yeah, the direct materials, it was also, $325, but that's less than 1% of the total. So we're good with that, even though it's a fairly big number comparatively here. But the factory overhead, $350 there, $350 out of that total, that's 3.7%. That's not good enough. That we need to look at that more. Let's figure it out where that's coming from. So again, there's no right or wrong answer to how management decides which variances to investigate and which ones are close enough. And whether they look at it at the big picture, the total manufacturing cost, or they look at each one of the components separately, as we've done here, or they take it even one step further, like we're going to do in our next exercises, and look at not just direct labor in total, but direct labor, price, and quantity. Management should have a policy, Anything over X amount, and it might be a dollar amount, but more likely it should be a percentage, so that as the company's size changes, we're still being consistent. The company should have a policy where we're investigating anything that reaches this level. In financial accounting, we refer to that as material differences. And we usually use the guideline of 5%, but it's really up to the company. Let's answer our questions here for part C so we can keep going. The company's actual costs were $425 less than budgeted. Remember that negative tells us it is a favorable variance. That means we spent less than the standards would have indicated. We had an unfavorable, this is direct materials and factory overhead first, were favorable, and then an unfavorable direct labor variance. So again, we can tell because of the negatives and positives. It's important that we have those negatives and positives correctly positioned so that we can simply sum this column rather than having to think about which ones have to be added and subtracted to come up with our total. Okay, so there is our budget performance report. We're going to be using the flexible budget to make sure that we are being rewarding appropriate behavior, and I don't want to say punishing, but correcting behavior that is not efficient. The company is going to decide of these variances, which ones need to be investigated further. One last comment, then we'll move on. We need to be very careful that we aren't only investigating unfavorable variances, because favorable variances are a good thing, and we want to figure out, is this something we can sustain? Do we expect to have this happen month after month? Is there something we need to do to make sure they keep happening? In part because those favorable variances help to offset some of the unfavorable variances, and sometimes they might be related. And we'll see that as we get into the detail in the next exercises. Questions about where we are at this point? Anything we've talked about so far? All right, well, let's get into the detail then. And we're going to move on to direct materials. Just want to give you a kind of a preview of where we're going. We may not get through everything today that I would have expected, probably because I spent more time talking about the project. That's important stuff, so that's fine. But you'll notice that this exercise is direct materials variances. Oops. No. As is exercise 4. Exercise 5 is direct labor variances, and exercise 6 brings them both together. So we're going to do exercise 3 next, and hopefully we have time then to do exercise 5 on direct labor variances before we run out of time today. At the end of class, we'll see where we are, excuse me, if we've gotten through direct materials and direct labor, but run out of time. I would ask you to try 4 and 6 on your own because they're just reinforcing, practicing again with what we've already done. So that will be the goal. And then when we come in on Thursday, we'll be ready to move ahead to exercise 7, excuse me, which is the overhead variance calculations. We'll see where we are 18 minutes from now. Direct materials variances. The following data relate to the direct materials cost for the production of 50,000 automobile tires. We have one direct material, or we're looking at this in total. Okay. As usual, we are using a simplified version, but if you can do it for one direct material, you can do it for 10 direct materials, or 20 or 50, or however many direct materials go into the product that you are producing. Just as I've been saying in the previous exercises, the company may look at direct materials all together and see how close are we. And then if there's a major or a material difference, then they start investigating individual direct materials from that total. It may be that they focus on just a handful of direct materials that make up the bulk of the cost. Again, they want to be efficient. They have to look at that cost benefit analysis. Yes, we may have spent 15 cents on something that should have cost 10 cents. That's a 50% overrun, but it's 5 cents. So they're going to look at what makes sense to investigate further. Do we need to investigate this at all? So we have our actual compared to our standard. And we can already see what? That they used less of the material. They used 5,000 pounds less. That's a favorable variance in quantity because they used 5,000 pounds less than they expected to use. But the price, they expected to spend $2.95. They actually spent $3. Remember when per pound. Remember when I said there might be a relationship between these? It could be that it costs more because it was a better product and that's why they had to use less, or they only used, they used less of it. They saved 5,000 pounds of product because they bought a better product and so they had less scrap or less rework, less non-conforming materials. It is absolutely possible, maybe even likely that that's what happened here. And we'll see in total, did they save money? So I'm going to go to the total direct materials variance first. As I said, some companies may start there, may start at the total and decide, do we need to go any farther? How close is this? Is it a problem? So the actual spending, we bought 725,000 pounds of this material and it cost $3 a pound. Our actual spending was $2,175,000. Based on the standards, how much should we have spent? 730,000 pounds at $2.95. We should have spent $2,153,500. Okay. We spent 5 cents more a pound. We used 5,000 pounds less than we expected. The 5 cents extra was more than offset, or sorry, I said that backward. The 5,000 pounds that we saved was more than offset by the 5 cents extra we spent. Our spending in total was higher than what we budgeted for or what we planned for. So that's an unfavorable total variance. Whoops, I just subtracted the wrong number. Unfavorable variance, oops, of $21,500. And we are consistently through this chapter, through these exercises, we're going to show a favorable variance with a negative number, but we also are labeling it as favorable or unfavorable. So are we worried about that? It's about 1% of the total. I don't know. I don't know how worried the company is about it. Maybe this was an experiment. They did, let's try using that more expensive material and see what happens. And then they're really going to want to dive into this to see, Did it make sense? Should we go back to the cheaper material, the $2.95 stuff, because it didn't actually save us any money? Yes, it saved us 5,000 pounds of material, but it didn't save us any money. Everyone with me so far? Does that make sense? So how, again, we can't answer those questions, but we can talk about what might happen or what maybe we want to look at. Let's go to the price variance then. We've already pointed out that the price variance is 5 cents per pound. And the actual quantity we use, so 5 cents per pound times 725,000 pounds, the price variance, 5 cents per pound times 725,000 pounds we actually used, that's a favorable, no, sorry, that's an unfavorable variance because we spent more than we had planned. Unfavorable variance, we show it as a positive. In your textbook, in the PowerPoints, if you find it beneficial, ignore my numbers there, those actually. In the PowerPoints and in your textbook, there are, skip ahead here. You will find formulas that may be helpful for you. For me, I don't find the formulas particularly helpful. I prefer to think about, well, why is it that? Where do the formulas come from? Rather than handing you a formula and telling you, okay, plug the numbers in. But you may find it beneficial to see the formulas. This is the total. So you may find it beneficial to look at the formulas in your textbook or in the PowerPoints. You guys, you know, you have access to the PowerPoints. I don't tend to think of these as a plugging into a formula, but as a what makes sense here. But I do want you to be aware that the formulas are out there in case it is helpful for you to see those formulas in front of you. Let's go to our quantity variance then. We already pointed out, just looking at the data that are provided, that we used 5,000 pounds less than we expected. So we already know it's going to be a favorable variance, and we're going to show it as a negative number. I'm going to put those in already. So how favorable? How helpful was that we used 5,000 pounds less? Well, the 5,000 pounds that we didn't use, we expected, the standard is that we should have paid $2.95 for those. So 5,000 pounds savings at the standard of $2.95 per pound saved us $14,750. Now, what you will notice is that if you add together the price variance and the quantity variance, keeping in mind the quantity variance is favorable and negative, it equals the total. So we've just taken that total direct materials cost variance and separated it into its parts. Here's what's because we spent 5 cents more than we planned, than the standard would indicate. Here's how much we saved by using 5,000 pounds less. And those two things combined or netted together gives us the total variance. Make sense? Okay, let's answer our questions then here. So what do we do with this? What do we do with our direct materials cost variance? We've separated into its price and quantity. We took the extra step, we took the extra time to figure out where that variance came from. And as I said, in addition to fixing or correcting, adjusting our actual costs on our financial statements that are going to be shared externally, the other big point of this is to help manage, help run our company more efficiently. And so what do we do with this? The direct materials price variance should normally be reported to, well, who's in charge of buying it? We should be reporting that to the purchasing department. Hey, you know, the standard says $2.95, we paid $3. Now, again, as I suggested, maybe we already know that. Maybe this was a deliberate experiment on our part to see what happens if we use that more expensive material. I don't know. But we need to do something with that. It's not enough to know that it happened. We need to tell the people who are in charge of making decisions. Our job as accountants is to report what happened, not to make a decision about, hey, don't buy that material again, but here's what impact it had on our results. When lower amounts of direct materials are used because of production efficiencies, the variance should be reported to the production people. Hey, guess what? It worked. Good job. Whatever you did to use less material, it worked. Good job. When the favorable use of raw materials is caused by the purchase of higher quality raw materials, which is what I suggested may have happened, the variance should be reported to purchasing. Hey, we bought those more expensive raw materials and it helped us use less of that material. Maybe the answer is keep buying it. The accounting department's not going to make that decision. We're going to tell the people who make the decisions, here's what our analysis of the results show. You figure out what to do with it. Oh, whoops. Jeez. Sorry, just clicked the wrong button. I don't know what it would have done if I had said yes, submit for grading. I can't submit for grading. So direct materials variances, looking at the totals, separating it into its components of price and quantity. Any questions about that? Okay. So definitely before Thursday, I would like you to, or outside of class anyway, I would like you to try exercise 4 on your own. And let's see how we do with exercise 5. So exercise 4 will be more practice, same concepts, more practice with calculating direct materials variances. Now we move on to the second component of the product cost, which is direct labor. The following data relate to labor costs for production of 20,000 cellular telephones. We have an actual compared to a standard. Now, even though we call them different things here, we call it a rate variance and a time variance, it really is the same conceptually as what we did with direct materials. How much did we use? How much did it cost per unit? So you can call them whatever you want. You can think about them however you would like. It comes down to the same thing. How much did we use? How much did it cost us per unit? Just like with direct materials, we'll have a total and then we tease it into its how much did we use, how much did it cost us per unit. So let's again start with the total because as I suggested, some companies may start and stop there. We may do that calculation and say, good enough, and not take the extra time if there's not a lot to be gained by teasing that apart. So the actual costs, 8,450 hours at $22.50 an hour. Our actual costs were $190,125. How much we thought we would spend on direct labor, $193,200. So similar to what we saw in the last exercise, where we have differences on both ends, how much we used, how much it cost per unit. Our actual hours were more than we had planned, but our actual per hour cost was less. What might have happened? Maybe these are new employees, they're still training, or they're just not as fast as our more seasoned employees, but they're also cheaper, right? Because they're new. That could be, that's just one example. But it might be that our company looks at this difference, the standard 193,200 compared to the actual, and they see a favorable variance, we're going to show that as a negative. We see a favorable direct labor variance of $3,075. And we compare that to the standard and see it's about 1.6% of the total. And we may look at that and say, good enough. It's within our tolerances of 2% or whatever we've decided is acceptable. Or they may say, yeah, let's see what really happened there. Let's figure out how much of that is because we used more time and how much of that is because we spent less per hour. So we'll go to the rate variance first. How much did we pay? Well, we can see, looking at these, that it's a 50-cent per hour difference. Okay. A 50-cent per hour difference, and our actual hours worked, 8,450 hours. Oh, that's our time variance. No, that's our rate, sorry, that's our rate variance. I don't know what I was just thinking. 50 cents an hour was the savings we had. I may have said that backwards, somehow I confused myself. So 50 cents an hour we saved. Favorable variance of 42.25. We saved 50 cents an hour. Maybe because our employees were new, unseasoned, needed a little bit more time. They're still in training or what have you. Favorable variance. But it took us 50 extra hours. The 50 extra hours it took us at the $23 we expected to pay is an unfavorable time variance. An unfavorable time variance. Took us longer than we thought. But the money we saved, 50 cents an hour, more than made up for the fact that it took us a few extra 50 extra hours. Again, if you look at the totals, the rate variance and the time variance, when we net them together, gives us a total direct labor cost variance of $3,075. Let's answer these questions as we're getting close on time here. The employees may have been less experienced or poorly trained, thus thereby resulting in a lower labor rate. The lower level of experience or training may have resulted in a less efficient performance. Thus, the actual time required was more than standard. I would suggest that having poorly trained employees does not necessarily translate to a lower labor rate. I'm not sure why they threw that in there, because that doesn't necessarily follow. You know, that you tell employees, we're going to pay you less, but we're not going to give you the training you need to do the job. That's kind of weird.
Or maybe because they weren't trained, they didn't receive the training bonus.
Maybe,
So they cost
yeah.
less.
That could be. So they hadn't finished the training, sure.
Poorly trained is, probably
Yeah.
not that word.
Yeah. So we are basically out of time here. But we have finished one example of direct labor variances. So I would ask you to try exercise 4 and 6 on your own before our next class. When we come in on Thursday, I will start with, after our intro stuff, I will start with any questions on exercises 4 and 6. If not, then we will move right ahead to the overhead work in exercise 7. Any questions, concerns, anything? I did not schedule a drop-in session for this week. I'm perfectly happy to do that. I'm just not exactly sure when that would happen. So if you would be interested in having a drop-in session this week, please send me a note. Tell me what your availability looks like, and I can compare that. It doesn't make sense to schedule one if nobody can come at the time I schedule. As you've heard me say, I do have my program review thing on Friday, which is going to take up most of my day on Friday because I need to be available for that. So Wednesday or Thursday, if there's a time you'd like to get together, just send me a note and I would be happy to add that to my schedule. and go from there. Otherwise, we'll try again for next week. All right. Thanks for being here. See you all Thursday.